Andy Toburen, high yield funds have been flat to down so far in 2015. Is this still a hangover from the decline we saw at the end of 2014 due to the energy paper?
We think some of it probably is. Energy, as you've alluded to, was the worst performing sector in the second half of 2014. That said, it's stabilized so far in 2015. We're actually pretty constructive on the high yield bond market as a whole at this point, energy notwithstanding. Risk premiums, or the spread in the market, is at 475 to 500 basis points, which is pretty attractive to us. The domestic economy, as you mentioned, appears to be on solid footing and growing modestly. Default rates are in the 2% to 3% range, which is low by historical standards. And in an environment with a solid economy, reasonably low default rates, pretty good market valuation. We like high yield right now.
But what's the quality of the paper out there? I think the yield on most funds is around 6%.
Yeah.
Is that enough for the risk people are taking?
It is. You have to. It's a little bit of a nuanced answer with respect to that. The high yield market's a large market, about 1.5 trillion in assets. It's also a very diverse market. It's diverse with respect to sectors. It's very diverse with respect to quality, and it's diverse with respect to durations. So characterizing the overall market with a broad brushstroke is oftentimes misleading. There are lots of ways to play high yield. There are parts of the market that we're cautious on right now. Certainly the lower quality, CCC rated and distressed paper. Some of that is in energy, some of that is in metals and mining. That's an area where we'd be very cautious. On the other hand, we think the vast majority of the market, the 90% plus of the market, that's higher quality, that's double B rated, single B rated, and offers yields around that 6% that you mentioned, is a pretty safe place to invest and pretty attractive.
And the sectors that you like include, you told me the names of the places where you're wary of.
Yeah.
What about the places you like?
We like the consumer right now. Gasoline prices coming down has been, in effect, a tax cut for consumers. Consumer balance sheets seem to be in reasonable shape, so anything consumer related, retail, service, we think are good places to invest.
What about new issuance? Do you expect a lot more paper to hit the market before interest rates finally do rise?
New issuance so far this year is tracking about on pace with where it was in 2014. We're at about 190 billion of high yield new issuance. We'd expect that to remain steady and look a lot like last year.
And speaking of rising rates, you can give me your forecast. When will they go higher, and how will it affect the high yield market?
We give the Federal Reserve credit for being, we think, very transparent with respect to how they're going to handle interest rates. They've reiterated time and again that if the economy plays out as they expect, it would be likely to see, we'd likely see an increase in the Fed funds rate this year. I also give them the credit for making it known to the market that it's not necessarily the timing of that first rate increase that investors should focus on, but they should focus more on the trajectory of rate increases going forward and the path of rate increases, which every indication is that that path of rate increases is going to be gradual. If interest rates are going up, and I'll say going up for the right reasons, and the right reasons being that the economy is doing well, employment's strong, if interest rates are going up for that reason, that tends to be a very good time for high yield bonds. High yield bonds have performed very well historically in those market environments.
All right, well, thanks a lot for coming on.
Thank you.
Thank you for watching The Street.